You look at the pre-market screen this morning, Thursday, June 11, 2026, and the tape is, well, it is deliberately trying to bait you. S&P 500 futures are flashing green, up 0.8%. Nasdaq futures are pacing even higher at 1.1%.
Right, but the real risk here is ignoring the broader context. I mean, yesterday we watched the Dow absolutely bleed out,
Yeah.
shedding over 950 points.
Yeah, breaking below that psychological 50,000 mark for the first time since mid-May. Okay, let's unpack this. Our mission right now, literally minutes before the opening bell rings, is to separate the noise from the actual market mechanics. Is this a resilient market buying the dip, or is this just a trap?
It's a textbook liquidity trap. It's being engineered in the overnight session. I mean, Wednesday was defined by aggressive, indiscriminate institutional liquidations across the board.
So what we're looking at right now.
What we're seeing in the futures right now is absolutely not a structural recovery. It is a massive short covering bounce.
And the mechanics of that are crucial to understand before anyone puts capital to work today. The traders who made a killing betting against the market yesterday are, well, they're simply buying shares back to lock in their profits.
Exactly. That mechanical buying creates artificial upward momentum. You see the green? You might think it's a gap and go setup.
Right. The retail money sees the green and jumps in.
And that is exactly how retail money gets completely blindsided. If you look past the superficial price action and check the VIX, the volatility index, it's still highly elevated at 21.73. The underlying fear is entirely intact.
Yeah, it's a very fragile pre-market volume propping up a highly nervous market. The institutional research we are digesting gives us the exact lines in the sand for today's session. We are tracking a hard macro support floor at 7,300 on the S&P.
And a tight zone around 28,225 on the Nasdaq.
Which is critical.
Yeah.
I mean, if we slice through those levels today.
If those floors break, the short covering illusion shatters entirely. We are looking at a structural descent.
And those support lines feel incredibly fragile when you look at the heavy weather system bearing down on the market today. We are staring down the barrel of severe macroeconomic data. Yesterday's May CPI printed a scorching 4.2%.
Which is the highest we've seen since April 2023.
Right. And we are literally bracing for the 8:30 a.m. Eastern PPI print, which the street expects to show a hot 6.4% annual increase alongside the initial jobless claims.
If we connect this to the bigger picture, the primary catalyst driving those numbers isn't really a mystery. We're tracking a 3.9% monthly surge in energy alone.
And that is a direct derivative of the geopolitical tape, which frankly is deteriorating rapidly. The briefings confirm direct military exchanges between the U.S. and Iran.
Yeah, the CNTCOM strikes following that downed U.S. Apache helicopter.
Exactly. And as a direct result, the Strait of Hormuz is formally closed. Brent crude is immediately pushing near $94 a barrel.
That supply shock is the gravity pulling down everything else on the board today.
But let me challenge the weight of that narrative for a second. It feels like the market is standing in the eye of a hurricane, enjoying the sunshine while ignoring the 100-mile-per-hour winds surrounding it. If I am trading transport or airlines, obviously I'm panicking over $94 oil. But if I am trading enterprise software or mega-cap tech, why am I letting a barrel of Brent crude dictate my entry?
Well, why does the broader market care so much? Because energy is the foundational input cost for the entire global economy.
Right, it touches everything.
It does. When the Strait of Hormuz closes, it doesn't just make gas more expensive. Manufacturing costs jump, freight and shipping rates explode, and those costs are passed directly to the consumer.
Which bakes sticky inflation deeply into the system.
Precisely. Persistent energy spikes mean sticky inflation, which completely locks the Federal Reserve into a higher-for-longer interest rate path.
Right, they're cornered.
Completely cornered. The market is now pricing in a 98.3% chance of a Fed pause next week. Rate cuts are evaporating.
So with the Fed backed into a corner by inflation, the traditional safety nets that investors usually rely on are just failing. We are seeing severe structural damage in the market. The 10-year Treasury yield is parked in a highly restrictive zone at 4.54%.
Up from 3.96% back in February. It's a massive move.
Huge. And alongside that, the dollar index, the DXY, has bounced back to 100.10 on safe haven flows. Here's where it gets really interesting, because the institutional desks are calling this environment the pain trade.
Yeah, retail investors are actively buying the dip in long-duration Treasury ETFs, like TLT. They're hoping for a hedge.
The reflex makes sense on paper, right? Equities are volatile, so you pivot to bonds to preserve capital. It's the classic 60-40 portfolio dynamic.
But that relies entirely on negative correlation. What we are experiencing right now is correlation convergence. Both stocks and bonds are crashing at the exact same time.
It's like being on a lifeboat with a hole in both ends. There is literally nowhere to hide. But let's pressure test this against the mega caps. These tech companies have massive cash fortresses. Why does a 4.54% yield or a strong dollar even matter to them?
It comes down to how institutional analysts calculate valuation. The tech sector is fighting a brutal two-front war right now. The first front is the valuation squeeze.
Right, because of the discount rate.
Exactly. A 4.54% risk-free rate aggressively compresses the multiples of long-duration growth stocks. If analysts discount future earnings using that elevated 10-year yield, the present-day value of those tech giants takes a massive haircut.
Even if they don't need to borrow a single dime.
Correct. The second front of the war is the earnings drag. An elevated DXY over 100 silently kills multinational tech revenue.
Because when they sell software in euros or yen and convert it back to USD for their quarterly reports, the strong dollar just erases their margins.
It's a silent killer. Furthermore, while the mega caps have cash buffers, you look at small to mid-cap tech companies, and they face a terrifying debt refinancing cliff at these elevated rates.
Which brings us to how this brutal cost of capital is specifically cracking the market's biggest narrative. Artificial intelligence. We're entering what you call the AI digestion phase. Look at Oracle. They reported a massive Q4 beat yesterday. Record revenue of $19.18 billion. Cloud infrastructure up an astonishing 92%.
And EPS came in at 2.11.
A huge beat. Yet the stock is plunging 8 to 10% pre-market, trading down around 180.89.
Because of the massive Capex plan they attached to that earnings print.
Right. They are raising $40 billion in debt and equity for a $95 billion capital expenditure budget in fiscal 2027, strictly for AI data centers. We're seeing the exact same thing with Supermicro, falling heavy this morning on news of a $7 billion financing package for AI server components.
What's fascinating here is the psychological shift in the market. The AI industry is transitioning.
It's like a rapidly growing teenager. It's growing incredibly fast, but, it is eating investors out of house and home just to sustain itself.
That's a great way to look at it. The narrative is shifting from an exciting revenue growth story to a terrifying capital expenditure and dilution story. Investors are terrified of near-term margin compression.
Wait, Oracle had a 92% surge in cloud revenue. That is hard proof of demand. Why on earth is Wall Street punishing them for investing in the exact thing making them money?
Because Wall Street is structurally impatient. Building hyperscale data centers requires billions of dollars upfront today, but those physical centers won't generate accretive cash flow for years. Institutional investors see that $95 billion bill and instantly run the math on how it compresses margins over the next 4 to 6 quarters.
The demand is future dated, but the bill is due today. We are tracking some key levels for Oracle. If institutional buyers step in at the open and it reclaims $200, the market accepts the Capex.
But if it breaks support at 177.50, look out below. It signals outright capitulation on the physical cost of the AI build-out.
So if institutional money is fleeing bloated AI infrastructure costs, we have to follow the cash. Where is it going?
Capital never sleeps. It just rotates.
Yeah.
And right now, it is aggressively rotating into contractual yield and safety.
The pre-market heat map confirms that. Financials, specifically the XLF ETF, are the pre-market winners. Alternative asset management is catching a huge bid. Air's management is up 3.34% this morning, trading around 134.97.
And that's off the back of them closing their Pathfinder Fund III at an $8.5 billion hard cap in under 6 months.
Which proves institutions are craving high-yield private credit and defensive cash flow as a shelter from tech's volatility. But Air's isn't the massive event sucking up the rest of the liquidity today.
No, the real liquidity vacuum is the SpaceX pre-IPO pricing happening tonight, ahead of tomorrow's debut.
This is a black hole. They are fixing the price at $135 a share, raising $75 billion. That values the company between $1.75 and $1.77 trillion.
Debuting at nearly $2 trillion fundamentally alters the capitalization weighting of the entire stock market.
And the demand book is wild. It's showing $250 billion. That is 4 times oversubscribed.
But the mechanism that's going to cause chaos here is passive index inclusion. Index providers are fast-tracking SpaceX into their benchmarks.
So what does this all mean? How does a single IPO structurally drag down the entire broader market? It's so massive, it's literally sucking the oxygen and the cash out of the rest of the tech ecosystem.
Well, an index fund's legal charter mandates that it must hold shares in exact proportion to the market cap of the index it tracks. When index providers fast-track SpaceX, those passive funds are mathematically forced to allocate a huge percentage of their portfolio to it.
And they don't just have $75 billion in cash sitting on the sidelines.
Exactly. They're forced to algorithmically sell off their existing holdings. That means massive, indiscriminate liquidations of Apple, Microsoft, Nvidia, just to free up cash to buy SpaceX.
And to throw a massive wrench into this, Senator Elizabeth Warren has formally requested the SEC delay the IPO.
Which introduces severe regulatory uncertainty literally hours before the pricing locks in. If the $135 price holds, we see a massive validation of demand. But if regulatory pushback causes a delay, it triggers a sharp speculative pullback across all tech.
So you are stepping into a treacherous playground today. Between sticky 4.2% CPI inflation, the death of the 60/40 portfolio, AI's staggering Capex bills, and this SpaceX liquidity drain, blind dip buying is a massive risk. Don't let the pre-market green trick you.
And I want to leave you with a final thought to mull over. We just discussed how companies like Oracle are projecting $95 billion in capital expenditures to physically build out the AI future.
Right.
But with the Strait of Hormuz closed and oil spiking, consider this. What happens to this trillion-dollar physical AI infrastructure build-out if geopolitical tensions spill over into the global semiconductor supply chains in Asia?
Wow, if physical supply lines freeze while the cost of capital is sitting elevated at 4.54%, the margin compression we discussed today will look like a best-case scenario. That is a heavy thought to carry into the session. I want to thank you for joining us on this deep dive. Keep your eyes on the macro tape as the bell rings. Watch those levels, 7,300 on the S&P and 28,225 on the Nasdaq. Trade smart, stay defensive, and we'll catch you on the next one.